Okay, so thank you all for tuning in today to this quarterly update video. We're doing it a little bit of a different structure, as those of you watching live know. We're doing this live, and so part of that is it gives us the opportunity to answer questions in real time, your questions in real time. So just a little bit about the format that we're thinking. Mark and I will go through our quarterly update, talk a little about markets as they have been, our expectations for the future. And then if anything comes up during that time, please feel free to type in a question into the chat box. Or if you had a question that you brought to this evening, feel free again to type that into the chat box, and then we'll get to all the questions at the end of what we have to say. And that's, again, if you're watching this live, because we are going to be recording this and posting it on YouTube and sending it out with the quarterly statements in a couple of days here. So if you're watching it on YouTube, feel free to send us an email with any of your questions. We'd be happy to answer that way. So Mark, why don't you take us into the bond markets?
Sure. I'll add this. If you feel like turning on your mic and saying something, feel free. That'd be fine too. Probably the best call Tarek and I have made in the last 3 years was in March 2020. And that was on about March 20th. I think it was exactly March 20th. The market was what you might call in a tailspin or in the toilet, whichever is your better picture. And most of us felt like running for the gates. And it was our observation that we thought it was better to stay in. The market did bottom on the 23rd. Now that there happens to be a weekend in between, so it was almost one exact day later. It was a Friday till Tuesday when the market bottomed on the 23rd, and by April 10th or 15th, I don't know that exact date, it was already at 15%, and it continued to climb out of that ditch. In other words, selling at the 20th would have been just poor timing. That's my first comment, is on timing. Timing is very, very difficult. Number two, early this year, you might say our second best call of the last 3 years, meaning we've made others that have not been so good, but we're rather selective in our recall. Was this idea that the bond market is a hostile place to be investing. And, we said that right from January. It appeared to us that the bond market was a hostile place to invest. Now, that has proven to be true. The volatility of bonds is multiples, like 2 or 3 times the volatility of the stock markets right now. And that's just not a good place to be, is what it's saying. Rates are likely to continue to rise. So the conclusion on that one is we would continue to encourage you to think about moving assets from, sort of bond weighting into equities. It's a little late in that. In fact, in the last quarter, bonds have been performing about equally, both badly, with stocks. So you might say there's some balancing between that. Overall, that hasn't hurt us too badly. Even our heaviest bond weighted portfolios have outperformed the Toronto Stock Exchange year to date. So our strategies are working, and we'll talk about why we think that is on the fundamental indexing or the enhanced indexing. The reason to be careful about bonds for the future, that is for the next 6 to 12 months, is that inflation is still around. Both the US Fed and Canadian Central Bank have a mandate to manage inflation down. And that becomes sort of objective number one. And the other is to give price stability. And Tarek might talk a little bit about price stability. But inflation is still around. You might notice, when you go to whatever it is, the gas pump, the grocery store, or even still, houses are still, year over year, quite high. In other words, they should come down a little bit relative to price from a year ago. So there are many, many ways of saying inflation, and core inflation doesn't include houses. But inflation is still around, and the central bankers, whether it's the US Fed or the Canadian, have a determination to fight it. So they've had several increases of 75 basis points. Most market seers are saying there's still going to be another 2 of 75 basis point increases in the Fed rate. So that's 75 points, 150 total for the next probably 3 or 4 months. We need to get that through the system before bonds will begin to look better. And I was just reading, a bond newsletter that came in a couple of days ago, and they're grasping for straws when all they handle is bonds. And they're trying to say, well, at least now there are some decent bonds to buy because yields are so much better, and they're giving all of this context. And they're right, because the best bond you could get, the best bond yield you could get several months ago was 2%. Now you can get 5 at 6%. It's probably going higher, and it's probably staying up here at this high level for a while. Okay, I think that's all I need to say on that, Tarek. I could talk for quite a while. There might be a question that people have. There might be a question that people have about why are interest rate increases a bad place to be for bond investing, and that's a technical description. It's not that hard to understand, but I'd be happy to do that later. Why don't you go ahead with the other thing? One more thought. Is my mic working okay?
Yep. Yeah, I hear you. No problem. Okay.
Yep. One last thing, in an inflationary environment, how do you hedge against inflation? Well, the answer, albeit I'm talking from the perspective of someone who is a genuine equity person. I am a stock buyer and have been for all of my career. So there's a bias in my advice, but I think it's correct, especially in this environment. The place to hedge against the risk of interest rates rising is stocks. What happens when you have inflation? Well, companies are charging more for their product. Number 2, they get their higher revenue out of it. Number 3, their profit goes up. Therefore, the stock price should continue to reflect the growth in revenue and the growth in earnings. In a high interest rate and high inflation environment, multiples come down. So higher earnings should attract a lower price earnings multiple. So therefore, the stock price will not keep 1-for-1 equivalent, but you will see earnings growth just because of inflation. That will flow through better to stock prices than it will to bonds. Okay, Tarek, over to you.
The U.S. Fed, and I want to talk about the U.S. Fed because in comparison, the Bank of Canada is small potatoes. Whatever the U.S. Fed does is really what matters. And they do try to make it relatively simple in that they say we have 2 jobs to do at the U.S. Fed: price stability, which is inflation, and to maintain full employment. And they do, to maintain full employment. If unemployment is high, they lower rates to stimulate the economy. If unemployment is low, they increase rates. So currently, as everyone knows, inflation is really high, and that's an issue. So they have to increase rates for that. Now, the other part of the mandate is employment. And in the United States, you don't hear this headline as much, but unemployment is also historically very, very low. They're at 3.5% as of the early October numbers. And so all that to say is the Fed their mandate is employment and price stability. And that means they cannot and they will not stop increasing rates because they have that's their job. Employment's low, inflation's high. They have to go forward with rates.
Let me follow that with sort of double tap that point. In other words, they have much ammunition in their arsenal to raise rates without it hurting the other part of the mandate, and that is keeping people employed.
It's true.
Yeah,
that's also true. And I think I do also want to touch on what you mentioned too, that stocks end up being a good place to have your money. And I think that's juxtaposed with the fact that this year has been very tough in capital markets, as we're going to see in just a minute. But I think what we're seeing there, and it maybe hasn't unwound yet, was that, in the last 2 years, because of COVID, there's very, very favorable lending, banking, and interest rate policies, and we're sort of unwinding and getting back down to reasonable valuations. And then we're going to start to see the good companies like you described, Mark, that can pass on these price increases to their consumers, that have built moats around their business where they don't have to worry about the competition stealing their customers away because they're increasing their prices. They will begin to benefit. Good companies will start to, I think as we start this earnings season, maybe the next earnings season, we'll see that it will increase. There will be bright spots, much more bright spots in the economy as we see companies are starting to demonstrate that earnings growth from these price increases that they're passing on. I think it was just a bit of a reset or a comeback down to reasonable level.